Welcome back. Thank you very much for staying with us. It's been called a big interest rate decision. The governor of the South African Reserve Bank, Lesetja, Kganyago, is expected to keep interest rates unchanged when he announces the Monetary Policy Committee's decision this afternoon. This despite the announcement yesterday of a 4.8% inflation rate. Other analysts say there's a risk that the committee will hike the rates by 25 basis points. Professor Andre Roux is an economist at the Stellenbosch Business School, and he joins us via Teams to give us his view. Professor, good morning. Thank you very much for your time. Many are indeed saying that it is the biggest interest rate, or at least one that we're looking sharply at. There are those that are saying there might be no hike, while others are saying 25 basis points. Where do you stand?
Good morning. Yes, I think these days, every couple of months, we say almost the same thing, a huge decision. I think on balance, I would go along with the consensus view, rates unchanged. Look, we could argue from both angles. We could argue for an increase, and there are compelling arguments. Although inflation is behaving itself, there are still some upward risks. We know that the fuel price has gone up and will go up again quite substantially. Food prices are galloping along. Wage increases are still imminent in some parts of the economy. Excuse me. And very importantly, we must bear in mind that elsewhere in the world, such as the USA and Europe, there's still quite a hawkish stance in terms of rising interest rates. We don't want to get lost there. Mm-hmm. So one could argue for an increase. Mm-hmm. Conversely, one could argue for a lowering. We know about the parlous state of our economy. We know that consumers at all levels are really finding it hard to survive with rising food prices and high interest rates. We know the economy is not in a recession, but really in the doldrums. We know unemployment is high. One could argue for a decrease. Also bear in mind that a lot of the inflation in the system now is not really affected by monetary affairs. The Reserve Bank interest rates have no control of international food prices, of the international price of oil. But weighing up the two, and bearing in mind that the Reserve Bank does have a very specific mandate, and that is to do its very best to keep inflation under control, I would argue unchanged for now. Mm-hmm. In fact, I would argue perhaps, given our current information, unchanged for the rest of the year. And if we cross fingers and hold thumbs, maybe sometime in the course of next year, we might start seeing the first signs of a relaxation.
Mm-hmm. Very interesting take you have there, because your counterparts are still arguing that the 25 basis points would probably be in line with the US Fed, that this is where we would want that alignment. What do you make of just their argument there?
Yes, well, as I pointed out, that is a strong, compelling argument that needs to be considered for an increase. We don't want to get lost or lag behind the rest, because the risk is if elsewhere interest rates are rising and they're not doing the same here, the risk is a further weakening of our currency. And that will in turn bring about more inflation. So you've got to weigh that up against, as I said, the upward risk in inflation because of food prices and the like must be weighed up against the current state of the economy. We know that fiscal policy, the fiscus is under huge pressure. And we don't know how that's going to unfold. Either means less government spending, which hurts many people, and or it means higher taxes, which is painful, and or it means more borrowing, which is painful, which exerts even more pressure on interest rates. So as I say, taking the two into account, the two opposing poles into account, I'm going to go for the neutral outcome of things unchanged for now.
Mm-hmm. And then broadly speaking, Professor, if we look at the more left-leaning scholars, they're constantly stating that you cannot continue to go this route of inflation targeting. What are your views, broadly speaking, on this particular subject?
Yeah, this is a difficult one. But, you know, the underlying sort of story is, and we find this all over the world, that you cannot buy short-term economic growth by simply lowering interest rates. It creates so many more problems. If lower interest rates result in much higher inflation, then somewhere down the road, we're going to have to get a very harsh increase in interest rates, 3, 4, 5 percentage points. So it kind of makes more sense, and it's always weighing up, there's always a trade-off here. Makes more sense to get inflation under control, stabilize things there, create a more stable environment, which in turn is a prerequisite for longer-term sustained economic growth. You don't want this sort of seesaw kind of thing. Low interest rates now, a little bit of better growth, not all that magnificent, but much higher inflation rates. then you're back to square one. Then you have to go for much higher interest rates, and it all goes tumbling down again. So it's painful, yes, but that's the essence of economic policy very often. There are always trade-offs involved. To resolve one problem, you might create problems elsewhere in the economy. The Reserve Bank, in a certain sense, doesn't have it easy, but they are guided very clearly by the Constitution. And as long as the Constitution says what it says, that the Reserve Bank is tasked with keeping inflation under control, well, that's it. One could perhaps question the constitutional mandate, but it is sacrosanct for the time being.
Mm-hmm. Professor, you sounded exactly like the governor. You could do well as our governor. Thank you very much. He's always telling us that we have to deal with the pinch currently for us to be relieved a bit later on in life. Thank you very much, though, for your insights. That's Professor Andre Roux speaking to us ahead of that all-important announcement.